Hello, everyone. I am Philip Nelson, head of asset allocation here at NEPC. We're going to get started here with our quarterly webinar. Joining me is Jennifer Appel, my colleague on the team, and we're going to spend about 30 minutes talking about our market outlook, outlining what we are seeing as some interesting dynamics in equity markets, especially on the growth side. So we'll be spending a few minutes there. Maybe just a quick minute on some logistics. This session will be recorded and posted on our website, likely tomorrow. If you do have a question, we've saved some time for Q&A at the end, so please enter your question into the question box in your top right of your screen. And with that, we'll start getting into the content here. Before we talk about kind of growth in equity markets, Jen, maybe you can give us a quick rundown of what we've seen over the last quarter, maybe the year to date in terms of the market environment.
Yeah, sure. To me, it seems really that we've had these two pretty different quarters to start the year. If you think back to kind of the end of Q1, there were lots of geopolitical concerns that came about at that time, and more concerns about growth and inflation alongside that, in addition to maybe these bigger picture concerns around AI-related disruption, where we saw growth markets in particular coming under pressure. So as we flipped forward to the second quarter, all of these things were still looming. And despite that, the second quarter was very different. We saw an extremely strong risk asset return environment. One, because markets were able to look past the geopolitical noise that happened. And two, that there was not much of a change in the resilient economic backdrop, including the continued ramp up of CapEx and the AI cycle that had a meaningful impact on earnings and expectations. So just lots of tailwinds for markets in Q2 overall.
Yeah, I mean, it really seems like when we kind of just looking back at the year so far, January and February, we're a clear trend in terms of, seeing kind of non-US assets doing well, small cap assets doing well, top of the stack of the equity markets and top 10 names, delivering strong earnings, but not as much price appreciation as I think we've been used to over the last several years. Last day of the month of February, conflict in Iran starts and, almost kind of put a pause in the market activity for a few months. And you really kind of see kind of market recover and some of those trends from the beginning of the year kind of come back in with kind of by mid-April in terms of kind of the market dynamics. And I think one thing that's been really interesting is we think about kind of emerging markets, generally kind of exposed as oil importers, should be more adversely impacted by the conflict in Iran, but in some cases doing really well. But I think if you look below the hood, and you spent a lot of time on this, Jen, there's some kind of interesting change in terms of just index composition that we haven't seen maybe ever in terms of that index.
Yeah, and that's probably a good mental note just for folks if you haven't taken a look at the MSCI EM index as of late. You might think it was dominated by China, India, kind of those cyclical commodity-driven markets. And now it's over 50% Korea and Taiwan. So really different growth profile that's being that is going through that index, and a higher beta just overall to the US and the AI cycle as a result.
Yeah, and I think it is a little bit of a challenge at times as we think about positioning in portfolios where you have two or three names, in HK Hynix and Samsung and Taiwan Semiconductor, really dominating the market landscape in EM relative to kind of the AI trade in the US, and in terms of what is emerging markets really these days. And in some cases, it feels like kind of two separate markets that have really fractured over this last year, but especially the last quarter, really feeling it.
Yeah, and I know we've been talking a little bit so far about just AI, but one of the points that I think was really interesting from this last quarter is all the conversations around is AI a bubble, I think have kind of gone by the wayside a little bit because it wasn't this buy everything AI trade that we saw. And the reason why I say that is that when you look beneath the surface, there was some more dispersion across markets, like you're talking about with EM versus the US versus EFI, but also even within the tech sector itself. So I think there was more of this fundamental scrutiny that took hold. And you could see it very clearly in US markets. If you looked beneath growth, there was a big difference between software versus hardware. And again, it gets back to that fundamental scrutiny. Investors were rewarding companies that had that real earnings growth that are a key part of the AI supply chain today, where there are constraints that are helping margins.
Yeah. Yeah. And I think, as part of that, somewhat tangential to that as well, we saw a lot of either both announcements and actual activity in terms of IPO activity and capital markets activity. So, SpaceX's IPO, obviously, in recent weeks, we had SK Hynix's ADR issuance. Google announced kind of very large equity offering, kind of outsized, I think, many people's expectations in terms of an equity raise. So there is a lot of demand out there clearly for liquidity. And I think one of the questions that we've been asked is the liquidity demands of some of these kind of large kind of equity raises, if you will, pulling capital from other parts of the market. And we've seen that a little bit, but I think for the most part, and Jen, feel free to jump in here. We see kind of the depth of the equity markets across the world, and especially in the US, as plenty of capacity to continue to provide kind of be a liquidity provider for kind of new investments that arise, and also kind of IPO activity that we don't see destabilizing, let's call it the core market or established market.
Yeah, and maybe just to add to that, this was something that we talked about at the start of the year, that we were expecting more activity across markets. And some of this I view as a reflection of the macro backdrop. It's been a plentiful liquidity, a good, favorable environment, and you're seeing still pretty strong demand for AI coming out of the market. And this feels a little bit more like a normal IPO cycle, aside from maybe the size of the deals that we're seeing, but getting away from the last couple of years that have been a little bit more quiet on that front.
Yeah, I don't know what your normal IPO cycle would be, Jen, but it's good to see some IPOs coming to market, nevertheless. So with that, why don't we pivot a little bit and talk about some of the kind of growth and earnings dynamics that we're seeing in the market. Something that I've been kind of fascinated by, especially over the last 6 months, but really kind of feeling it close to a year now, is almost an enthusiasm gap that exists between investors and the growth projections and earning projections associated with, let's call it, the AI complex. I don't know if it's exhaustion. I don't know if it's doubtfulness about the benefits or the productivity benefits of AI, which is still an unknown over the next 3 or 4 years. But for a cohort of companies, and especially kind of in the tech space, or let's call it kind of generic growth space, there is what looks to be fairly strong visibility and kind of earnings growth. But you feel a lot of questioning coming from investors, especially as we talk to clients here at NEPC.
Yeah, and I think one of the top questions that has been posed to us is just about the ultimate level of AI exposure that's present across portfolios. And it's probably a little bit flippant to say, but we may kind of point to the fact that AI is almost everywhere in portfolios. There are certainly more quantitative driven exposure management exercises that can be done to try to get to what's the exact sector or company exposure. But I think that misses a little bit of the big picture here, and kind of the bigger pulse that this has on the economy, especially from a macro standpoint. With the CapEx build out that we've been discussing, that is almost this stimulus at the macro level that is flowing through to corporate earnings, to expectations, to economic activity. So, there's real impacts there that has on growth, inflation, and rates as well, outside of just the standard asset class format.
Yeah, because I mean, just sentiment aside, clearly, AI is having a big impact on kind of investor sentiment. But I think as we look at, kind of the macro backdrop, as you were saying, and just kind of economic growth for the US economy, if you will, you take out that CapEx boom or that investment cycle associated with AI, I think it's not a leap to say the economy likely would be in a recession. And so the absence of AI has real implications on Fed policy, has implications on inflation trajectory, jobs growth, where the treasury rates are, shift in the yield curve, credit cycles. And I don't think it's a flippant answer to say, AI is everywhere in your portfolio. It is a beta that I think in many ways transcends different kind of asset class segments. And I think that's an okay risk to associate. I'm not necessarily suggesting, and we're not suggesting this is a risk to hedge out, but I think it's just a known aspect of the dynamics of the market today. And I think if we look into the equity complex a little bit more and just kind of thinking about the size of the boom that we're seeing, is this a super cycle? Is this a kind of moment of excess from, the hyperscalers in terms of their CapEx spends? And I think however one wants to portray it, whether pro or negative on the AI side, there's trillions of dollars that are going to be spent over the next 12 months and probably over the next 24 to 36 months in greater size, that I think there's a relatively high level of confidence in that these spends going to occur.
Yeah, and maybe just to offer the risk side of that, obviously these dollar amounts are out there. They're getting larger and larger seemingly over time, but the financing requirements associated with that are becoming more significant. So when we talk about the hyperscalers in particular that are committing these huge dollar amounts, you're starting to see those outsized cash piles that were there over the last handful of years getting depleted, and even they're looking at other avenues for financing. So tapping debt markets, for example, with a lot of new supply coming online, they're related to AI. So I think it becomes just increasingly important to demonstrate for them that there is sufficient demand, that there's ROI on this spending, and it happens really before that there's some strain on the balance sheet side of things.
Yeah. Yeah. And maybe, you know, to continue that, what are some of the risks that you see, Jen, associated with, let's call it kind of the AI spending cycle or kind of the AI investment cycle?
Yeah, I think one that's been coming up a lot recently is more of the political risk associated with this. There have been even a large number of data center projects that are blocked or delayed in 2026. So you're just seeing a little bit more opposition come about given the resource consumption, the pollution, et cetera, relative to the perceived benefit that these can provide to the community. While at the same time, local municipalities may like the idea of having that kind of tax revenue case being built in. So interests may not be perfectly aligned there. So, I bring that up because potentially if there is more traction, more opposition, that throws sand in the gears. And I think that can be something that adjusts the growth trajectory for earnings, especially moving forward if this slows down as a result.
Yeah, in some ways, there's a little bit of a race against time in terms of whether it's getting data centers up quickly enough, addressing some of the supply chain constraints that maybe exist in the kind of memory segment, in supply chains that are clearly experiencing kind of high demand, and really can the CapEx spend turn into physical locations quickly enough to start supporting kind of sufficient ROE growth and ROI growth for these initiatives, and start generating cash flow for the companies relative to the speed with which these assets will start depreciating over time. And this is, I think, one of the kind of risks that the market is kind of looking at, is how near term is positive cash flow going to be coming in relative to expensing and depreciation of the assets over time. And I think the other aspect of this, and this is probably a 3 to 5 year question, that I think we all can have opinions on, and frankly, no one has a clear and concise answer on this, is what are the economic productivity benefits likely to be generated by AI investments. And I think it's probably likely that the market's overestimating near-term benefits, but maybe underestimating long-term benefits. That said, the level of change that needs to occur in the daily job tasks for most folks in the labor force needs to be much higher. But also growth and kind of use of AI agents and other aspects is accelerating quite a bit. So if there's one number I think kind of we'll focus on over the next 3 to 4 years is what is the aggregate productivity level of the US economy? And is that experiencing some sort of step function where it's pushing higher, where you're getting that much more output out of workers, that much more output out of kind of per dollar spend? And I think that's a really critical piece to kind of focus on right now.
And maybe just to kind of switch gears a little bit, obviously we've been talking about the market backdrop here. I want to just spend a couple minutes talking about our outlook and positioning. And I know that the title of this webinar is Growth at What Price? But I think you've probably heard from our comments today so far that we are more favorable on the growth segments of the markets today. And a lot of it gets back to the earnings and earnings growth expectations that we're seeing. And in particular, I know we've spent a lot of time, Phil, talking about just the valuation premium associated with growth coming in so much relative to the broad market that it looks almost attractively priced today when you look at those forward-looking metrics.
Yeah, when you look at assets and their forward pricing relative to other asset classes within the equity segment, it sure looks like growth is cheaper than it was at the start of the year. And some of that is just as simple as looking at kind of forward PE multiples, which have come down since the start of the year. Some of that is kind of looking at some other kind of valuation metrics in terms of kind of free cash flow growth and others. But when we look at, in some ways, some of the outsized earnings projections that we're seeing from kind of some of the large growth names out there, stock prices not moving as much as kind of we've experienced. And that really starts to bring down the valuation multiple. And so I think to some degree, trying to shine a light on this is quite important for us because we can take two segments of investors and ask, is the market expensive today? And some will say yes, and some will say no. And depending on the data you use, both answers are probably correct. But as we think about kind of on a forward level basis, looking at companies that are growing, 15-20% plus in revenue earnings levels above and beyond what the market is relative to kind of more, traditional or conservatively growing businesses. I think there's a benefit to skewing more to growth. And a lot of that growth is originating in the United States today.
And maybe one other thing, obviously we're talking about growth here, but I think there is a favorable backdrop for equities more broadly. We've spent a fair amount of time talking about how this has impacted the tech sector specifically, but the earnings growth that we've seen, especially over the last year or so, has been really broad-based. So I think you pair that with the macroeconomic backdrop today, and it points to just a more favorable equity view overall and wanting to maintain a little bit of an overweight there relative to other parts of markets.
Yeah, I mean, certainly coming into the start of the year, we had a favorable view of the U.S. economy. Just looking at kind of nominal growth levels, we thought would be higher than we've seen in the past. Potential for more M&A. The regulatory environment has become looser for both companies to merge, combine, conduct transactions. We have the implementation of the tax cuts and the tax package from last year, providing a tailwind for U.S. economy. So we've had a lot of aspects that we kind of looked at. Okay, these are tailwinds that are present for the U.S. economy that flow through to equity markets as well. And a couple of all points that have popped up. One, concerns around inflation. I think if we said at the start of the year there would be effective blockade of the Strait of Hormuz, but equity markets from start to finish would not be overly impacted. I think we would be very surprised, and I think it shows the extent and the importance of the AI spending boom on not just the U.S. economy, but kind of global markets. And I think back to, over the last 10 years, really been hoping for in the US, many investors, some sort of infrastructure boom to flow through, the United States, whether that's, tunnels and bridges and roads, which I think we all agree maybe has occurred slower than would have liked to see. But we're effectively getting what's essentially is a digital infrastructure boom occurring in the United States, trillions of dollars coming in, being spent, put to work, and that has a lasting impact as long as productivity benefits are provided. And it is an ROE and ROI that is greater than a lot of these companies are financing, which certainly seems to be the case. So as we think about what inning are we in this cycle, it sure seems on the earlier side in terms of our outlook, which is a positive aspect when we think about kind of trajectory for growth markets, especially when their valuations are trending a little bit lower than we've seen over the last 15 years.
Yeah. And maybe to talk a little bit about the fixed income side of things, since we've been talking more on the equity side, I think one of the other surprises maybe this year has been the move in interest rate expectations from the market. And maybe it's a little bit difficult to square with the data that we have today, but when you look at the backdrop that we had before the conflict in Iran, and at that time there were 2 cuts priced in versus the backdrop we have today, which I'd argue is somewhat similar. We're talking about a hike being priced in by the market. So very different dynamic just in terms of that pricing. And it's meant that just overall, we've seen the belly of the curve, the front end of the yield curve move quite a bit higher relative to the long end. So we are seeing maybe an attractive yield environment for some safe haven assets as well, in addition to that equity view that we hold. And then when we're talking about maybe 2 favorable views, the unfavorable piece of this comes back to credit, in my view. So I think you're hearing more of a preference of equity risk over credit, especially since spreads continue to grind even lower in this environment.
Yeah, when you look at high yield spreads under 270 basis points was historically is very very much on the bottom end of the spread range there. Limited upside in our minds in terms of on the public market side for non-investment grade credit, and much prefer to be tilting towards equities. Along with many of the comments we had in terms of thinking about kind of growth for equity markets in terms of earnings growth, and in some ways just following the earnings growth is probably an overly simple but quite successful investment strategy over the last 100 years. And when we look at kind of the expectations for equity markets, especially in the US, earnings growth projections are on the stronger side of projections. And then on the other side of that is thinking about, how do we have enough liquidity to either support, commitments to private markets, liquidity support, surprise drawdowns that occur. And we look at kind of the importance of kind of safe haven fixed income, looking at, highly conservative treasury allocations, for investors concerned about, taxes that have concern around taxes, looking at the muni space, high quality munis, the top end of the muni market, that's reliable and liquid is where we want to be placing our capital. And just to provide a little bit of a barbell of if you're overweight a little bit equities for some sort of surprise event that occurred, having that dry powder be available for various needs.
Yeah. And maybe it's helpful to just to spend a moment talking about our outlook on interest rates as well, because we mentioned that there's been this hawkish repricing by the market. And I think it's fair to say with the current backdrop and all of our comments today, we're a little bit more doubtful that some of those hikes are going to come to fruition. And I don't want to anchor too much to the CPI and PPI data that came out recently, but it's worth considering that that might be an early indication that inflation pressures are dropping across the economy as some of those supply side driven impulses are starting to fade. So looking forward, especially with maybe less certainty on the geopolitical front, that's one area where we could see a little bit of inflation volatility or inflation surprises coming at the headline level. But it sure seems that the core inflation pressures, all else equal, are softening.
Yeah, and I think one data point to kind of put some of that in perspective, as we produce our capital market assumptions that go into kind of long run 10 and 30-year assumptions, our path for interest rates that we use relative to market expectations, kind of quote the NEPC path, we haven't changed at all in the last 7 months. We've been very consistent, despite a lot of volatile data, and I think that speaks to the market's bouncing around a lot and is struggling a little to get a sense both from the Fed in terms of what their outlook is likely to be, but also just is there a lingering impact that will flow through to the service-based side of the economy or the rest of the economy from kind of the vol of energy prices we've seen.
Yeah. So I think in the interest of time, maybe we can kind of transition to Q&A. It looks like we have a few questions that have come in, and please feel free to drop in more questions if there are any. But I think I'll take the first one here just around the situation in Iran. We talked about that very briefly, but the question is, how are we thinking about this and the impact that it might have moving forward, especially now that it's back in the headlines? So I think anytime we talk about geopolitical risk, it's important to take a step back and understand that markets over the long run are resilient. And for the most part, especially as of late, they've been able to look past geopolitical headlines and volatility as of late. So anytime we'll see some type of escalation in markets, that could be a source of volatility, potentially fueling a little bit of risk off sentiment. But outside of really big disruptions in supply, it's hard to imagine that that's going to derail things completely and push oil prices back above 120 or even more per barrel. So anticipate for the most part that oil prices are going to be the mechanism that we see markets reacting to the situation. But even today, with some of the recent escalation, prices have yet to go back to those pre-conflict or right at the beginning of the conflict levels. So I think there's a little bit of maybe exhaustion coming through on the market side. But I think the most important piece also is just how this flows into Fed policies. So if we do get a little bit more inflation volatility, if tensions remain heightened, then that's something that could keep the Fed on hold or bring back some of those rate hike expectations that have gone out of market pricing in the last week or so.
Yeah. And one of the items you've talked a lot about in the last several months, Jen, is just the drawdown in, let's call it inventory levels for a range of energy products from oil to natural gas and others. That inventory needs to build back up, and to the extent that there's a closing of the strait or an impairment in supply, and you start delaying the building back up of inventories into the fall or even into the winter, that can start to be a longer term issue in terms of even greater price volatility as maybe we get into kind of the colder months in 2027. And I think the other kind of aspect of is resetting what a base case might look like. I think we've been kind of stuck on a view of, is there a conflict or not a conflict? Is there military activity or no military activity? But I think the baseline may be just a kind of an off and on aspect every month to this. That probably does, as you're saying, have a higher kind of floor of vol for the energy complex in the markets today.
Yep. So maybe I'll bring this next question to you, Phil, and I can chime in here as well. But we talked about our preference for US equities within the global equity complex. Um, can you just speak to the view of US versus non-US developed versus emerging markets, and how we're thinking about all of that collectively as part of a public equity allocation?
Yeah, as we're, looking at kind of longer term benchmarks, we look at, global equities as, ACWI IMI is the opportunity cost there. But thinking about kind of where the growth is today and um, where we see kind of friendlier valuations, if you will, relative to that growth, skewing more towards the US and, comfortable with letting US, should it outperform, build up some overweights in the US space. In addition to, looking at the smaller segment or kind of small caps, smaller, large caps, kind of mid cap space in the US, benefiting from kind of overall nominal growth in the US. So that said, experiencing and feeling a bit of a skew towards the US um, amongst kind of our equity exposure. And we mentioned this earlier of, looking at emerging markets really in two separate ways. There is the emerging markets that is a supply chain component to the AI trade for the United States. And then there's the emerging markets that is the more traditional emerging markets for the rest of the world. And when we think about some of the risks that are out there, whether it's monetary policy, inflation, kind of growth dynamics, energy access, generally speaking, more of those risks are exposed outside the U.S. Whether it's Europe and their ties to the Middle East in terms of energy levels or monetary policy tightening. So do have some concerns of uh, Europe's ability to keep growing over the next several years, especially relative to what we're seeing in the United States.
Yep. And maybe just to add on to that for the Europe piece, I think overall, one of the things that we talk about with Europe's economic backdrop today is just the faster inflation pulse that also comes from the Strait. So with the ECB's hiking bias maybe being there now and more stop-go policy around the Strait, it makes for a pretty difficult backdrop, I think, for them alongside kind of a weaker economic backdrop that we see there today relative to the US.
Yeah, yeah. And with that, one of the questions that came in is thinking about the growth story around AI. We've always spent a fair number of time commenting on the benefit for equities there and kind of where else can one experience kind of growth there, what asset classes are exposed to it, which is a more difficult question. But as we think about, let's call it the kind of the infrastructure boom associated with AI, there's physical, tangible plants being built, which require more power, more minerals. There are aspects of the kind of real asset space, whether that is, the need for just more megawatts, that are going to start to feel the stress as more and more of these data centers come online. So, obviously, very specific to kind of use cases here, but as we see kind of stress in energy markets maybe persisting because of the tension in the Middle East, thinking about how that flows through into kind of the real asset space and the energy market in the US as well is important. Okay, maybe one more question here is cycling through if you want to.
Yeah, I maybe to broaden this out, I know you just mentioned about other areas that might see the benefit of AI eventually, but we haven't talked a lot about private markets. And there have been a lot of dollars in the private market ecosystem that have been to put to work around AI as well. So when we were talking about just AI being present in various parts of the portfolio, it's no longer just public equities or just venture. I think there's a much broader reach across private markets as well. So maybe Phil, if you have any comments on that too.
Yeah, I mean, I think it clearly has a kind of broader reach, across the board, and you see financing activity and obviously capital raises associated with that. And I think in general, kind of give you the company line as we think about, private markets today, is really to be, cognizant of kind of each individual's liquidity levels, liquidity needs, having a balanced, disciplined pacing plan to put money into markets we think is the kind of most prudent, access point. And as part of that, great opportunities will come up, we're sure, as we look to the various managers that have been underwritten across the board. Great. But we try to be efficient with everyone's time, so we'll keep this to close to 30 minutes. Thank you everybody for joining. I hope everyone has a great summer, and we will be chatting again in October to provide hopefully another great market for equities and talk about how great they've been. Thank you, everybody.
Thank you.